Coming into Amazon's quarterly financial update to investors, there was a lot of concern about how the business would adapt to the changing macroeconomic environment, and the risks were to the downside. But as I read through the company's conference call transcript, evaluated the shareholder letter, it looks more like Amazon is in a good position here. Now, the macroeconomic environment is not going to be good, but relatively speaking, Amazon is in a good position to adapt to the changing circumstances. The management team highlighted a few reasons that Amazon stock investors can be optimistic about its long-term prospects.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So first of all, the migration to cloud is still in the very early stages, right? Amazon said that more than 85% of the global IT spend is still on premises, so not in the cloud yet. And being in the cloud offers organizations many benefits, including shifting a fixed expense to a variable expense, reducing capital expenditure requirements, and putting smaller businesses on par with larger businesses in terms of access to services. But it's still very early days, right? Now, 100% of IT spending is not going to move to the cloud, but certainly more than 15%. And it's similar to if you look at e-commerce sales as a percentage of total sales, it's still very early stages. So in the longer term, Amazon has excellent prospects. And that's what the CEO says here, saying that this equation will flip in the next 10 to 20 years. More of the spending will shift to the cloud. The Before this generation of AI, Amazon thought AWS had the chance to be a multi-$100 billion revenue run rate business. But after the development of AI, we think it could be even larger. Interesting, isn't it? So before AI, Amazon thought, well, we can generate a couple $100 billion annually from our AWS segment. Now they think it can be even larger. That's how positive Amazon's cloud segment can be in the longer term. And Amazon is the leader in the space, generating the highest profit margins. It's invested arguably the most in the AI infrastructure. This year, Amazon's capital expenditures are forecast to be over $100 billion. Microsoft is forecast to be around $80 billion, Alphabet around $75 billion, Meta Platforms around $65 billion. So Amazon, again, this year will be the leader in capital expenditure spending. Now, not all of that will be going for AI, but certainly a large percentage of that will be, according to what management stated. They're also building out their new custom AI chip, Trainium 2, and it's starting to lay in capacity in larger quantities with significant appeal and demand. And that's great news for two reasons. Number one, Amazon gets to sell access to this chip to its customers who may want a more affordable option that don't want to go with NVIDIA's chips, which are more expensive and highly demanded. Secondly, it gives Amazon negotiating power against NVIDIA, right? Amazon is one of the biggest purchasers of NVIDIA's chips. And if NVIDIA starts to increase prices that they charge Amazon, Amazon can go back to NVIDIA and say, you know what? Since you're trying to charge us more money, we're going to reduce the purchase amount from you, and we're going to invest more in our own custom AI chips. Now, we know that our custom AI chips are not comparable to yours right now, but with continued investments over several years, we know we can close the gap, and we have access to the end customer while you don't have access to the end customer. So we can facilitate, we can emphasize our chips when selling to customers and thereby shift more market share towards our own chips if you try to get ahead of yourselves in terms of pricing. So this is positive for Amazon for those two reasons. And they went on to say that it's 30 to 40% better price performance versus other GPU-based instances, and they're alluding to NVIDIA and others. So it's for the business, for the enterprise that doesn't need top-tier chip performance, but they want a lower priced option, and Amazon offers that to to its customers. And you can understand why they're investing so heavily in their AI business. Some investors raised concerns that Amazon will spend over $100 billion in capital expenditure following a year in 2024 where they spent close to $80 billion. And they raised concerns about this aggressive spending. But Amazon has long been an excellent company in terms of generating return on invested capital. The money that they spend comes back to Amazon more so than what they put out. So shareholders reap the benefits of those investments. And their AI business is already a multi-billion dollar annual run rate business, which continues to grow triple digit percentages on a multi-billion dollar base. That's a very attractive opportunity. And I can understand from an investor perspective why Amazon's management team is investing in this category so aggressively. It's still also in its very early days. Forecasts suggest that the AI industry will continue growing into the multi-trillion dollar levels by 2035. In 2024, that spending was less than $500 billion. So this market is expected to grow significantly over the next decade. Another reason why Amazon is well positioned to weather the macroeconomic uncertainty is because worldwide, third party sellers make up 61% of the units sold on Amazon's platform. And so they're not absorbing and they don't own all of the inventory on the platform, so they don't have to deal with 100% of the cost of goods sold, of increasing tariffs and sourcing and shifting supply. They can rely on their third party sellers to do a lot of that legwork, to do a lot of the due diligence and researching new manufacturing outside of China, finding ways to offset tariffs. They can rely on these third parties because they are interested in their own business, right? The third party business, the more they sell on Amazon, the more profits they make. And of course, they're interested in making more profits. And so Amazon can count on that to lift its own prospects over the medium and longer term. And already the improvement in the business has led to operating margins of 6.3% in its North America business, which is primarily e-commerce, and 3% internationally. So they've already reached economies in scale. They've already reached levels of capacity utilization that's generating strong margins. And so there's room to absorb some of the decrease in consumer spending while still remaining competitive in this dynamic marketplace. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.